What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is September 13th of 2022. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, I'm going to go on a little bit of a rant today. I want to spend some time to talk about the only reason why Bitcoin dropped over 10% yesterday. One of the worst downward moves we've seen in Bitcoin since the capitulation we saw back in June of this year. Now, I understand there are a lot of headlines out there. There are a lot of people searching for answers, but I'm going to be completely blunt with you guys here about what caused this decline. So if you enjoy the video, drop a like. Let's go ahead and kick off the conversation here. Now, it is not just Bitcoin that went down a whopping 2 digits yesterday. We also had the traditional equity market indices. For example, the S&P 500 down a whopping 4.3%, barely holding on by a thread. Its key support level here at around right under 4,000 points to around 3,966. We've got the NASDAQ here, which was not able to hold its two critical ranges we've been watching at around 12,400 and around here at 12,200. A clear breakthrough, down 5.5%. And on top of that, to make matters worse, the small caps, the Russell 2000, got shot down at 4%, facing clear resistance at previous resistance in the past at around 1920. And with market leaders like Apple coming back down to the corrective lows here from here early September, fading any of the potential gains that we had in the buildup of positive green candles that we had over these last few days, giving some hope to the bulls that things might be over. We have not only shot down on those gains, but the last nail in the coffin that proves that the market is truly uncertain and entering into uncharted territory is the volatility index, coming right back up to its relative highs, its highest level since back here during the midst of the last correction back in July. Now, I want to go ahead and spend some time. As we can clearly see, there was a lot of pain across the board. And I gotta be honest, while I'm totally fine hearing different opinions, guys, I'm totally fine getting some beef and, joking back and forth in all seriousness. I'm not mad at anyone out there who might disagree with me. I have to say, I've gotten a lot of flack for potentially being too bearish here at the lows, or at least that's what many people think are the absolute bear market lows for Bitcoin. A lot of people think that I flipped my tune too late, that I got a little bit too bearish here after, basically getting caught two steps behind. As you guys know, I like to talk about here in the channel. You don't want to get caught two steps behind. And over the last decade, during these kind of corrective price moves we've seen in Bitcoin, I would usually be 100% in the camp that those people are. Essentially saying, why would you get bearish when Bitcoin is down 70+% or 60-something percent? That's usually the time to start dollar cost averaging. And I've even emphasized on this channel, I just want to make it clear, I have no problem with dollar cost averaging. But I got to be blunt with you guys. What's happening here is not something that's happened over the last decade, and is a position in which Bitcoin has not been in throughout its entire history. It is why when we get 10% declines here, you're not seeing a lot of buyers come in. Because not only were there not buyers here to quote-unquote buy the dip after a 5% or 6% or 7 or 8 or 9 to 10% dip, it seems there's still no buyers coming in here at the lows. And there's a big reason for that. The big reason is the consumer price index and the cost of living, aka the absurd rates of inflation that we're seeing in the economy. Whereas many people thought last month we had seen quote-unquote peak inflation just because we had a 0% reading on the CPI, which I'm going to be honest with you guys. If you haven't built that skeptical personality yet, especially in times like this, you got to get smart. You got to tap into your street smarts and know that they're cooking the books on these metrics. They've done that with the employment numbers over the last 2 decades. It's gotten worse and worse as they've started to slowly but steadily change the definition of a lot of these metrics. Same goes with the CPI here. And we're going to learn that even though we understand that the CPI is cooked to a degree to look better than it actually is, The CPI report alone already speaks to the fact that we are very well far away from peak inflation, and that the Federal Reserve is going to have to get more aggressive with rate hikes. So, what do I mean about this? Well, let's go ahead and do something. As you guys might have seen yesterday, we did a live stream that talked about the CPI report coming out. But I want to go ahead and run through some data here. Let's go ahead and just simply dive in here to the Consumer Price Index from the U.S. Bureau of Labor Statistics. I know it looks overwhelming. I'm going to go ahead and dive into the real data that really matters to you here to really get an understanding about where the bulk categories performed month over month. Because that's really, if we're getting down to it, what really matters here. The CPI is going to be elevated for some time, but what we need to see in order to know that the Fed has control on inflation and that it's not going to have to continuously hike rates to a crazy degree and that it's cooling consumer demand. That's its goal, right? And that we are likely stepping into a necessary recession like we had back in the early 1980s, over 40 plus years ago. We need to see continuous month after month readings on the CPI of declines in the cost or the standard of living. And I can be honest with you all here that I don't think that's going to happen anytime soon. It certainly hasn't happened here in the previous month of August. Let's go ahead and dive into the data here. First off, we've got the first major category here. It makes up about 13.5% of the CPI. From here, for food, we can see that we had a 0.8% increase month over month. There was no decline in food-based prices here overall month over month. There was a near 1% increase for the cost of food. This is considering a lot of the staples that you commonly buy, from cereals and bakery products all the way down to a whole range of other different things that play into the weight here that we don't exactly have all the data on here just within the graph here. Mainly, again, coming in from a lot of those consumer staples. 0.8% month over month. Another major category here, let's go ahead and talk about energy, because this is where a lot of people had expected that we would actually get some relief here. And the main reason for that has to do with the fact that fuel and oil prices have gone down, mainly gasoline. A lot of people have been watching gasoline as it does make up a decent portion here of the CPI, or at least it's something that affects us as consumers on a very frequent basis. But I want to emphasize here the CPI reading, right? Whether you guys agree or disagree if this makes up this amount of portion of your spending or not, gasoline, all types, only make up 4.8% of the CPI reading here. It is a very small fraction here. And to be completely frank with you all, while gasoline has declined, it didn't decline anywhere near as much as we saw in the previous months. And that slowdown, right, and momentum is starting to concern a lot of people. And we can see that reflected in the price of crude oil, which eventually, if that continues to expand higher and hold at its current levels, it is likely going to continue climbing higher and push gasoline prices higher. So any relief that we were looking for here, right, this 12% decline here, roughly speaking, all the while that is good. It not only may not be enough to combat the rest of the inflationary items across the board, but on top of that, it may not be sustained by itself. It may continue to expand higher and turn positive month over month. So again, 1 month of flat readings on the CPI is not enough to verify peak inflation. But to make matters worse here, we need to understand the other elements here that go into the inflation reading. We can see here, for example, through even energy services here, mainly utilities, piped gas service, came up 3.9%, mainly due to a suspended natural gas price, right? And we've got a lot of other things here as well, like propane, kerosene, a lot of these other elements. I don't want to dive too much into it. Most energy commodities went down here. So that's some good news. I'm going to go ahead and say that that's a positive news piece here. But we've got to continue to come down here and dive into some other major items. Commodities, not including food and energy commodities, still up 0.5%. This is when you're talking about things like copper, you're talking about steel, a lot of the general commodities that are utilized for building, creating things could include lumber as well, right? Generally speaking, overall, a 0.5% increase. Does not look like peak inflation to me. Now, this is the month-over-month reading. I want to make something very clear here as we're diving through the numbers. And we've got some really shocking numbers when it comes to rent and the cost of living in a couple of moments. But I want you guys to realize here, when we talk about 0.5% increases month over month, this means that essentially what I paid for, if I paid $100 for something in July, right? This means that in August I'm paying $100.50, just for a simple mental model here. Now, that may not sound like a lot, but when we talk about the CPI commonly here on the channel, or the market experts out there who are talking about CPI, they talk about it on an annualized basis. So they do the usual reading that's around 8-something%, roughly speaking, at least over the past couple months, and that is the year over year. I think what's much more important is to focus here on the month to month and to see recurringly that the month to month numbers are in the negative. Now, we do have some items that are cooling off here, but when we take a look at the broader inflation metrics here, we can see that there was a 0.5% increase on what makes up 77.69%, over 3/5 of the CPI reading here. So what are some of those items? Well, in order to make this easier to track, we can just simply look along the sidebar here. While there's a lot of miscellaneous items, I want to go ahead and dive into the big things that make up a large cost for consumers. Used cars and trucks declined for the month a little bit. That's just 4%. A lot of people, again, have been honing in on these few select items that really don't make up a huge amount of the CPI. What we need to get to is what everyone is spending money on. And when money is spent on these items, as we've talked about with potential recessionary pressures, what kind of items are going to receive more money, or simply put, are going to be more expensive, that could potentially reduce economic spending in the physical economy, right? One of those big items that we need to talk about here is rent and shelter inflation, okay? Now this is where things get big. Month over month here, shelter costs went up 0.7%. Now, there is a big thing that a lot of people are focusing on here, and it's what makes up 23% of the reading here. Owner's equivalent of rent of residencies. Now, there's been a lot of, and as I called it before, market experts out there, and I get a little bit heated about this, and I'll talk a little bit about that in a moment, who have talked negatively about this metric, that this is not a realistic way to measure rent. And I'm going to be completely candid here and bring out a little bit of facts, which is that if the Fed, no, it's not the Fed, the U.S. Bureau of Labor Statistics, was not using this metric, we would see that rent inflation month over month is not 0.7%, but is likely 1%, 1.25%, much worse than what we're seeing here. I can practically guarantee that to you all. I would not speak with such absolute certainty unless I was certain about it. I almost called them the Bureau, the BI, the BS, instead of the Bureau of Labor Statistics, the BS. Okay, I'm sorry, I'm losing track here. Sorry, I get a little bit heated about this, but let's just go ahead and consider here that inflation, month over month, at least according to the CPI, is up a whopping 0.7% on average. Cost to live, just in a home or an apartment or condo, is up on average 0.7%. Now, I don't think you need the metrics to tell you this, guys. If you live in the United States, and especially if you live in any cities that are desirable to live in, some of I think the major cities that have been really getting hit hard are cities like Atlanta. Of course, you've got your major cities as well, like New York City, Los Angeles. You just go across San Francisco, all these major places across the board are in massive pain. I know people as well, and even cities outside of the ones I named personally, who are just getting crushed by rent. So when we dive into these numbers here, we need to understand that there are a lot of other things that make up the CPI. I got medical care here, up 0.8% here, month over month. Dental services, more specifically, up 1.3%. You just scroll through and you start to see that gasoline, essentially, is not the only thing that is making up the CPI. Education costs, up 0.5% month over month. This is definitely not looking good. Now, let's go ahead and talk into the ramifications of this, because we've obviously looked at the numbers. They don't look good. And we can see on a weighted basis, if you consider average hourly earnings in 1982 to 1984 dollars here, we can see that if we weighed in for the CPI here, wages are down here. The 12%, the 12-month percentage change here down into negative territory. Essentially speaking, this is why you feel like I can't keep up, right? I can't keep up with all the expenses that I have to deal with here. I feel like even though I'm getting maybe potentially a salary increase this year, maybe my boss gave me an inflationary bonus, I still just can't keep up with the cost of living. And it has to do with the fact here that simply the CPI is still outpacing wage growth. And let's just go ahead and be honest here, right? This is just adjusted for the CPI-based inflation. It's not considering real inflation. This is probably much more realistically -3 to -4, just being completely honest with you. And if that's the case here, if this means that the Fed has not cooled inflation yet, is there any rational person out there who feels that the Fed can pivot at this point? That the Fed can backtrack on its goal towards 3.5% for the federal funds rate? I got to tell you guys, I don't know of any single argument that can make that case, with inflation still not entering into deflationary territory, reducing the annualized inflation rate over time. But on top of that, we can see that according to history during the last inflationary wave, we had multiple waves of inflation and went to exacerbated levels. From a base of around 4 to 5% for the federal funds rate, the Fed had to hike rates all the way to 19%. This was during the Paul Volcker era in the early 1980s, late 70s, when inflation spiraled out of control. And the Fed had to go above the inflation rate with the federal funds rate. Just want to go ahead and talk about the size and scale of that. We went up to 19%. This means that the base cost of capital in the economy was 19% at the time. We are coming down from a near decade of 0%. We're only at 2.3%, or 233 basis points on the federal funds rate. We are going straight vertical now. The Fed is on pace to continue its hike of rates by 75 basis points at a minimum. And now the prediction markets are looking at something else. They're looking at the possibility of an increase of over 100 basis points, something that, again, had been laughed at by economists, had been laughed at by the positive market experts who have told us that nothing can go wrong, the Fed is in control, and that inflation is going to cool down. It's just going to get better, and we're just going to go back to the good times, right? The people who were absolutely right every single time when it was time to buy the dip for the last decade. Because the Federal Reserve would always come to the rescue. It could always lower interest rates. It could always increase the balance sheet. Unfortunately, though, it cannot do that this time around. It cannot come in and provide QE5. And the reason for that has to do with its need to cool inflation, because if the Fed does not cool inflation here, if they do not cool down consumer demand, this is not only going to be disastrous for the United States, it's going to be disastrous for the world. And we are going to have an economic crisis the likes of which we've never seen probably in our lives, far worse than 2008, because inflation can be that bad if you don't get a control on it. The sooner you address inflation, the better. And it is so sad to see people hoping for a market pivot and not calling for a necessary recession after all of the easy money that has been printed in the economy. Because if we don't tame it soon, inflation will tame the economy, and it will put us into a longer expanded depression rather than a temporary recession. Now, I did a poll the other day. We got about 853 votes here back a couple hours ago. You guys are welcome to vote on it if you want. But I asked people after today's inflation print what you all think the federal funds rate is going to. Right now, we're currently at 2.5%. Many of you out there are starting to step into the basket of thinkers that I fit into. I think at a minimum, we're going to 3.5 to 5% here. That's at least what I would feel comfortable saying right now. And I think you're going to start to see that reflected in the bond market. The bond market is at its highest level in a very prolonged period of time. So we can see that the bond market is pricing a very high chance, not only that the Fed is going to stick to its 3.5% target, but that it's likely going to start moving higher here. Now, some of you guys also selected the 5% or more category here, and I want to go ahead and hit on a really interesting point. If you guys don't know Stanley Druckenmiller, he is a major trader. He was a very famous trader over the last couple of decades, made astounding returns, made some really solid bets, predicted a lot of major bull markets in the past. Very respectable guy. Okay, and if you guys don't listen to him or don't follow him, I definitely recommend you guys go check him out, learn a little bit about his past. But the big thing I want to go ahead and talk about here is that there was a really interesting recording that got shared here on Twitter where he talked about the fact that once inflation goes above 5%, which we've already gone up to 8% CPI inflation back in July and in August, once inflation goes above 5%, it has never come back down without the federal funds rate exceeding the CPI. Now, I got to be honest with you all. The data pool that Stanley Druckenmiller is using for this is a bit limited. And I'll be honest, I don't agree with the clear fact that we're going to have to go up to the inflation rate. If we went up to about 8%, 8.5%, potentially 9% on the federal funds rate, the economy would not just enter a recession, it would be crushed. And I don't think that the Federal Reserve is going to go to that length. Maybe it has to for a very short period of time, but it will be short-lived, just like it was back in the 1980s. What I think this speaks to is that those who think we can only go to 3.5%, let's take the Fed for its word right now, are going to be sorely, sorely punished when it comes to their investments and their positions because they're thinking too optimistic. This is not a bull market. This is a bear market. And it is not like the traditional bear markets, the 20-30% definition that people utilize during secular bull markets where things just continue to expand. If you just look at the major indices here, or if you look at Bitcoin on that logarithmic chart, right? When we zoom out here, turn off our drawings, right? This is a secular bull market where we have miniature declines. I call them corrections. I don't think of them as bear markets. They're corrections along the way. 15, 20, 30%. Buy the dip opportunities. And a lot of people think that we are in yet again another one of those opportunities. But I got to be honest with you all. I really, really can say with pretty large degrees of confidence, and I'll go ahead and say I've got my money where my mouth is. We're in cash at the moment. That it simply isn't like the previous 10 years because the Fed does not have the same tools. The federal government does not have the same potential ability to run even bigger budget deficits. It's already running at maximum capacity. And if the Fed needs to cool inflation, I tell you guys, there's a couple things you need to consider here. It means that the Fed can't provide monetary stimulus. Well, what about physical stimulus? Can the government step in? Well, the government can't step in because right now, it's already having to pay a much higher degree of interest or yield on its debt. The net interest on the debt is already a crippling factor in the budget deficit, which is just making the problem even bigger, right? Now, if we consider the fact here that over the last year, people made astounding returns on capital gains, paid out, helped to balance the budget a little bit more than where it would have been, right? We had a lot of people making money in the stock market, a lot of people seeing increases in their salary. We are not going to be seeing that this year around. And that is going to mean a lot less tax revenue, and that's going to exacerbate the deficit even more. The government's going to have to issue more debt out there. They're going to have to dump more bonds on the market. And as bond prices go down because of that excess supply, yields shoot up. The demand for the government to be able to finance its current expenditures here are going to push bond yields even higher, which means, more likely than not, a higher federal funds rate. Now, I want to go ahead and just put this all into perspective, guys. Where do I really think things are heading here? Right? I know I sound really negative, stuttered on my words a bit here, right? And I mean, guys, look, I don't want to be too doom and gloom here. You guys know if you've watched this channel long enough, those of you who really watch the channel religiously, I'm not a gold, silver bug. In fact, I'm more of an optimistic type. I'm a passive optimist. Essentially speaking, I believe that over time, equity markets, crypto, most assets are going to appreciate. And it has to do with the simple fact that when we're not in an inflationary environment, we've seen the financialization of our economy. It's not something I actually really like that much, but it's a reality that we usually live in. Essentially, where central banks have gotten to the resort where instead of actually trying to stimulate economic growth, they just stimulate asset markets. And I'm going to take advantage of that, like any of you out there want to, when times are going good. But we also need to understand that there are periods of time, and they are brutal periods, that will cripple investors. When we look at the dot-com bubble, when we look at 2008, when we look at any of these major collapses, 1987, These types of bear markets will crush investors. They will take, in the case of crypto, various positions down to zero. We really got to find the plays here that are going to stand out in the market, that are going to lead forward, that actually have interesting value propositions. Same goes with the stock market. There'll be a lot of stocks that get crushed, a lot of tech companies that get brought down to pennies and get acquired by private firms or larger publicly traded companies for pennies on the dollar because they simply were not able to switch to profitability. And on top of that, the cost to finance is going to get increasingly expensive. And as that interest rate goes up, a lot of business models that might make 1, 2, 3, 5% a year are going to start losing money. And that's why we need to do this quick. We need to see the Fed shock and awe. We need to see 100 basis point increases for the next few FOMC meetings. We need to cripple demand in the economy, put ourselves into a temporary dip, temporary recession, cool inflation, stop excessive consumer spending. And we need to reduce the balance sheet as well. That's another big thing people aren't talking about. It's not just the federal funds rate here. It's about reducing all that excess printed liquidity. And once we see that, we can start to see a lot of exciting plays coming. We can see equities and asset prices at much lower valuations than where they are now, providing a great dip buying opportunity. The reason I'm so hawkish right now is because I understand the weight of inflation. And I want you guys to know that if you're dollar cost averaging, there's nothing wrong with that. But you got to do it slow. Don't go too heavy into the market here if you are in cash right now. Let the market come to you. Let it come and give you the discounts you're looking for. Nothing too crazy, but generally in line with the historical norms. 50% or more down, at least 45% or more down. Right? Let the market come to you. Let it give you a great opportunity. And one of the few plays here that we've been watching within the crypto markets here that I think is definitely one to watch when it comes to the layer 1 protocols is Kava Network. Now you guys know we've talked about them a good amount here on the channel. They're not only our sponsor for today's video, but they've been a protocol we've been covering as far back as back in, I think, 2019, 2020. They've really continued to develop throughout the bull and bear market, and they're continuing to build even more now than ever than they have over the past few years with the launch of the Kava Network. And one of the big developments they've had as of recent on the Kava Network is the whole wave of existing DeFi protocols and new DeFi protocols that have moved onto it. And one of them is the Curve Finance protocol. Now, many of you have probably heard about Curve Finance. They're one of the leading DeFi protocols that allows for very deep liquidity trades for stablecoins like USDC to DAI or USDT, all these different dollar stablecoins. And what's really cool is that Kava is offering the ability, as Curve has started to migrate and deploy onto the Kava network, to earn 115% APY in the native Kava token. I know it sounds crazy, but it's important to understand that the yield here is in Kava token. So essentially speaking, on an annualized basis, you're not only getting yields from providing liquidity into the Kava iteration of Curve Finance, but on top of that, you're earning Kava tokens here. So it's similar to staking in a sense. By providing this liquidity and putting your capital to work, you can earn a large degree of APY. So if you guys are interested in Kava Network, I would go ahead and say that it's best to, at a minimum, stake your coins, your Kava tokens, or deploy them. Provide liquidity, right? And one of the ways you can do this is by taking stablecoin liquidity that you might be holding at the moment and earning some Kava tokens by essentially providing liquidity on Curve. Not to mention earning potential fees as well in your native stablecoin. So if you guys are interested, there's an article here throughout their Medium. They just posted about how you can bridge USDC and other major assets here into multi-chain and bring it into the Kava network, how you can supply into the Kava 3 pool on Curve, and on top of that as well, claiming your tokens, your Kava tokens that are earned. And if you want, how to bridge your tokens back to the Ethereum network. It's really interesting, guys. If you want to take a look at it, definitely consider checking it out. But Kava is one of our top layer 1 plays that we're watching going into 2023. After we go through a kind of further crash in the market, it's definitely one of the plays we're watching. If you guys haven't already, though, definitely follow them on Twitter at Kava_platform. Keep up with the announcements they got. It's one of the projects we're watching. But I want to go ahead, close things off here, taking a look at the VIX, guys. If you disagree with everything I said in this video, this is one of the key charts that tells us where we're at right now. Volatility is riding high. It's been continuing to expand since 2017. And I think there's a fair argument to be made that back in March of 2020, when we were seeing the decline we had with, with you know what. I don't want to talk about it on YouTube, might get demonetized. Essentially speaking, what happened back in March 2020, I think, was the start of the real depression that we were going to enter into that was well overdue, a real correction in equity prices. And unfortunately, we provided all the wrong types of monetary stimulus to get the economy flowing again. We just put money into financial assets, and that stopped volatility. And while that might sound good, to be completely honest, this distorted things. It left equities going up to ridiculous valuations, and it left retail investors, more importantly, holding the bag. And it did not bring us back to a point of low volatility like we had in 2018. Do not let equity prices fool you. The market has been growingly uncertain for the past 4 years. And it is only going to get worse until we get inflation under control and go through a proper economic recession. I am not looking forward to it. I don't want anyone to deal with any economic pain, but recessions are a normal part of the business cycle process. And until we properly cool consumer demand and go through stagflation, where inflation prices still remain relatively high versus salary or income increases, and we go into a proper recession where we get enough cool down in the cost of goods and services, only then, once we have a true control of inflation, when we see things return back to normal and have the good times come back. And I can promise you all, there will be a lot of exciting opportunity when that time comes. But until then, we're going to stay vigilant here on the channel. We're going to continue to talk about this topic. We're going to continue to dive into the macro picture. And I hope you guys will join me on this continued journey on the channel. If you enjoyed today's video, drop a like. It's one of the best ways you can support the channel. Consider sharing it with a family or friend member. We got to get more people informed now, more than ever, to prepare for this upcoming opportunity that's going to be coming in the next couple of months, the next year. But we got to be patient, guys. We got to be patient and vigilant and search for that opportunity. That being said, everyone, thank you all so much for watching, and I'll see you all in the next video. Take care, everyone.